The market is currently closed for the day. The final closing price for Tilray brands today was 1.17, representing a significant drop of 6% for the session. This figure, though appearing to be a minor price point on its surface, belies an undercurrent of intense speculative pressure and a deep-seated tension in the market's core expectations for the company. While the mainstream narrative often frames Tilray as the quintessential cannabis play, a pure bet on federal legalization in the U.S., and a leader in a nascent industry, this perspective misses the real drama unfolding beneath the surface. The stock's dramatic intraday volatility, which saw it swing from a high of 1.28 to a low of 1.16 before settling, isn't just about the long-term hope for regulatory change. It's an immediate, visceral reaction to a far more urgent and tangible threat, the potential for a reverse stock split. This immediate and pressing concern, driven by Nasdaq's minimum bid price requirement, is the true catalyst driving the daily gyrations and investor anxiety, a reality that deeply contrasts with the widely held, more optimistic, long-term narrative. The stock's performance over the past few days has been a masterclass in market psychology. On a day where broader markets were relatively stable, Tilray plunged, extending a multi-day decline. This isn't a random event. It's a direct reflection of institutional and retail investors reassessing the company's immediate future. Volume has been a key indicator, with a notable increase accompanying the recent downward pressure. This suggests that the selling isn't just from small, panic-driven retail exits, but also from larger players liquidating positions, as the immediate regulatory and financial risks become too pronounced to ignore. The optimism that fueled a spectacular 123% rally in the last month, a move largely predicated on the hope of U.S. proper cannabis rescheduling, is now clashing with the harsh reality of operational fundamentals and looming compliance issues. This tension between the speculative hope for a legislative windfall and the pragmatic need for corporate stability is the central conflict defining Tilray's valuation today. It's a battle of narratives, the dream of legalization versus the reality of a company struggling to maintain its Nasdaq listing. For context, Tilray Brands Inc. is a global cannabis and consumer packaged goods company. Its operations are broadly diversified across four key segments: cannabis, distribution, beverage, alcohol, and wellness. The company's business model is built on a global platform with a presence in Canada, the United States, Europe, Australia, and Latin America. It's a key player in the medical cannabis space, particularly in Europe, where it holds leading market shares in countries like Germany. The company's strategic acquisitions, such as its purchase of Hexocorp, have been aimed at consolidating market share and achieving operational efficiencies. Furthermore, Tilray has made a significant push into the beverage alcohol sector, building a portfolio of craft brands in the U.S., which it views as a strategic entry point into the U.S. market, positioning itself to capitalize on potential federal cannabis reforms. While the core of its revenue still comes from its cannabis segment, the diversification into beverages and wellness is a crucial part of its long-term strategy, designed to build a more resilient and globally integrated consumer goods company. However, for all the strategic vision, the company has historically struggled with consistent profitability. Its last quarterly report, while surprising with a positive adjusted EPS, saw a notable revenue miss, highlighting the difficulty of translating market leadership into sustainable financial performance. This perpetual struggle with the bottom line is why the market is so sensitive to any sign of financial or operational stress. The recent launch of new EU GMP-certified medical cannabis strains in Germany, while a positive step in a key market, does not fundamentally alter the near-term risk profile. It is a logical, strategic move, but it doesn't solve the core financial headwinds. The real driver of the stock, as the recent volatility shows, is the ongoing saga with Nasdaq. The company's need to maintain a one minimum bid price is not a trivial matter. It's a litmus test of investor confidence and a gateway to institutional capital. The discussions around a potential reverse stock split, while a necessary evil to maintain compliance, are often seen as a signal of corporate distress and can be highly dilutive for existing shareholders. This is the exact kind of real-world challenge that clashes with the high-flying expectations of the legalization rally. The fact that the stock is now trading dangerously close to that threshold and has been granted an extension to regain compliance only amplifies the proportions. Tension. The market is not just trading on future hope, but on the very real fear of a stock split that could effectively reset the share price and, psychologically, erase some of the recent gains. This brings us to a crucial question for investors. Do you believe the ongoing regulatory momentum in the U.S. particularly the potential rescheduling of cannabis, will come soon enough and with enough impact to save Tilray from its near-term financial pressures and the looming threat of a reverse stock split. The market, through its recent price action, is showing an increasing degree of skepticism. While positive volume balance on some days might suggest sustained buying interest from those betting on the long game, the more recent sell-off on high volume points to a clear shift in sentiment. The smart money appears to be taking profits or even shorting the stock, anticipating that the operational and compliance-related headwinds will materialize long before any sector-wide tax-relieving legislation is passed. This is a classic case of a stock whose valuation is driven more by external political catalysts than by internal company-specific performance, a dangerous and highly speculative proposition. The future outlook for Tilray is a direct function of this expectation versus reality dynamic. The expectation is that Tilray, as a first mover and global leader, is the primary beneficiary of a future multi-trillion-dollar legal cannabis market. The reality is that the company operates in a hyper-competitive, still developing industry with complex regulatory hurdles, high operational costs, and persistent unprofitability. The bull case rests on a handful of high-impact catalysts: U.S. federal rescheduling, further European legalization, and the successful integration of its beverage alcohol portfolio to drive sustainable revenue. If any of these catalysts hit, the stock could see another explosive move to the upside, potentially reaching or exceeding analyst price targets that range well above its current level. The bear case, however, is a more immediate and sober one. Continued losses, the execution of a reverse stock split, and dilution of existing shareholders, all while a broader macroeconomic slowdown could tighten access to capital. The recent insider buying from CEO Irwin D. Simon and CFO Carl A. Merton is a significant signal of confidence, but it must be weighed against the company's continued need to explore options like a reverse split to maintain its listing. The tension between these two opposing forces is what makes Tilray such a compelling, yet risky, investment. It's not a buy and hold for the faint of heart. It's a high-stakes bet on political timing and operational execution. Comment below how many shares of Tilray brands you would be willing to hold if you knew a reverse stock split was coming. In the end, the story of Tilray brands is not about a simple, linear path to success. It is a complex narrative of a company caught between two worlds: the aspirational world of a future legal cannabis market and the challenging, unforgiving reality of its present-day operations. The recent stock price action isn't just noise. It's a clear signal that the market's attention is shifting from the distant promise of legalization to the immediate threat of corporate instability. The initial expectation was that the company's diversified model would make it an ironclad play on the entire industry. The reality is that this very model, while promising, has yet to deliver sustainable profitability and has left the company vulnerable to the very real and mundane risks of listing compliance. Until the company can bridge the gap between its ambitious vision and its tangible financial results, the stock will likely remain a highly speculative vehicle, driven more by whispers of political change than by the strength of its own business.